Morning, everyone, on this bright, sunny spring morning. Welcome to our webinar on tax governance in the private equity sector. This is the third in a series of webinars hosted by BDO's Tax Assurance and Risk Management team. My name's Martin Callahan, and I'm a partner in the team focusing on financial services and private equity. And today I'm pleased to introduce a great panel of colleagues from BDO. Have Jenny Wall, Private Equity Fund Tax Partner, Nuala McLaughlin, Transaction Tax Partner, Will Searle, Transaction Tax Director, and Emma Bailey, a Senior Manager in the Tax Assurance and Risk Management team. Any questions during the course of the presentation, the webinar this morning, please use the Q&A function and we'll endeavour to answer those questions at the end of the webinar. If we don't have time, there will be follow-up and we'll seek to address some of the key issues. So on to the next slide, what's on the agenda? Well, we're going to start with a brief discussion of the importance of the private equity sector and the application of tax governance to the fund and PE manager. Jenny will focus on some of the current hot topic tax issues for houses and PE executives. Then it'll be back to me to discuss the ways in which tax governance can assist on the PE journey. The idea being to demystify the component parts of a robust tax governance framework before Nuala and Will run through common areas of risk that arise on due diligence. And then we'll conclude. Emma and I will conclude on the ways in which the house can gain assurance over the compliance of the portfolio during the investment lifecycle and some of the tools that we use with our clients to ensure the journey is a successful one. So next slide, please. And then one more time. Great. So by the end of today's webinar, you'll have a better understanding of the part that tax governance has to play in making the PE journey a successful one, helping to bring about transformational growth and enhancing and protecting value. Now, private equity is one of the key pillars of our business at BDO. We work with over 1,500 PE-backed businesses and collaborate with more than 400 PE houses. In 2024, we advised on completed deals totaling £19.5 billion. And private equity is incredibly important to the UK economy as well, because PE investment helps a business to maximise its potential. It provides capital to fuel growth and expansion and brings valuable industry knowledge and strategic guidance to the portfolio. Put simply, businesses that take on PE do better. But what part does tax governance have to play in this? Next slide, please. Well, let's break it down into three key areas: the fund, the manager, and the portfolio companies. Now, clearly there are other areas which will be relevant to the PE house as a whole, but for simplicity, let's keep it at that. Now, each of those layers has its own complexities and stakeholders to consider. Jenny will soon cover off some of the main tax issues for the fund and PE executives, but the rest of the session will focus on portfolio company compliance, with more detailed discussions on fund and manager tax issues scheduled for later this year. But if we start with the fund, structuring and finance are complex. Accurate and timely fund entity returns and investor reporting can be challenging. If we then add in taxation of the carried interest, taxable income allocation, FATCA, CRS, transaction taxes, and so on, it gets even more complex. And we want to manage this complexity and also give assurance to investors, regulators, and other stakeholders over the fund itself, but also importantly, clarity to the manager. Now, the direction of travel is for clear investment tax principles, sometimes referred to as responsible tax principles, fund tax policies, as well as documented processes and deals checklists. And if we consider the fund tax policy, well, this sets out expected behaviours, including commitment to compliance, clear roles and responsibilities, risk appetite, risk management framework, and so on. It formalises the decision-making process to allow for consistency and robust implementation. And although the policy may be owned by the tax and finance function, it should be shared to all relevant stakeholders to ensure the timely consideration of tax implications. Now, sitting below the policy, a series of process documentation. And the policy and the process, this isn't just for the purpose of efficient management of compliance and risk, although clearly important, it's also an important component of the agenda for ESG conscious investors. Investors want assurance that the fund has embedded responsible tax behaviours. Now, clearly, although the purpose of the fund is to generate tax-efficient returns for investors, there must be a commitment to do this in a responsible and sustainable way. For example, without aggressive avoidance, aligning planning with commercial reality. And it must also be ensured that there's a robust governance structure in place to ensure that these principles are followed. And we move on to the manager. Now, clearly the manager is integral to the success of the fund, but it's a separate business distinct from the fund entities. And the manager has its own compliance obligations to meet. And across both the fund and the manager, documented policies, procedures, deals and compliance checklists help prevent inconsistencies, errors, costs and reputational damage. And the direction of travel is also for the managers to take a closer interest in the tax operations of the portfolio companies, with a requirement for increased and ongoing assurance over portfolio tax compliance and increasingly more active involvement in making sure this happens. And we'll return to that shortly. But first, let's hear from Jenny about some of the key tax issues for PE houses.
Thank you so much for that context, Martin. And those themes really echo with me, and I'll touch on some of them in a little more detail now. For those of you who don't know me, my name is Jenny Wall, and I'm a tax partner here at BDO, working with clients to help them design their fund structures, provide quality tax information to the executives and to their investors, and also to manage all that day-to-day complexity Martin just mentioned of running a PE firm, a fund manager. So the lens that I bring to this conversation is very much related to the house itself and what investment managers themselves need to do to stand behind good tax principles when they're dealing with their investors and potential investees as well. I think we're all painfully aware that both raising capital and deploying it are more challenging than ever in today's market. The level of scrutiny and due diligence just continues to increase. So standing behind your principles is more important than it ever has been. And I would absolutely echo the kind of key considerations and practices that Martin's been discussing so far. And what we see is that really links into the tax technical areas that are the subject of HMRC change and challenge today. So what I'm going to do to bring this to life with that house lens is to talk through some of these key principles and link them to some current issues that impact private equity houses. And that should help illustrate the application of these to real life. So firstly, we'll talk a little about that commitment to compliance that Martin just mentioned, and we can link that to the tax reporting and compliance for private equity investors and executives. I think the second point that's really important, and again, Martin mentioned it already, is this idea of responsible tax planning. What does responsible tax mean to you? And looking ahead, I think we can see all the change around carried interest is going to crystallise a lot of thinking about tax risk and strategy. And then the third theme that I think is very interesting with that house lens is this idea of substance over artificiality. It's of course relevant to deals as well. New and we'll touch on some of these themes later. But from the house side, we still see that this is important, this idea of substance and representing the commercial reality. And we'll talk about that with the salaried members as a live example of those issues. So taking those one at a time, if we start with this idea of commitment to compliance, to me, what that really means is not just staying ahead of the curve and horizon scanning for issues. It really means having clear standards, clear risk management, and clear understanding of what your compliance obligations are. And it's obvious to think of the tax filing requirements for the funds themselves, for the management structures. But also it spreads further than that, as many of you will be familiar with. And a real area of focus at present for HMRC and the market is the tax reporting information that's given not just to UK investors, but very importantly to the UK executives, the people who work for the PE house. And what we see in the market is that those individuals who participate in private equity funds as investors or execs, they really depend upon the house to provide them the tax information that they need to do their own returns. And the house providing that information ensures consistency, it ensures clarity, and it reduces the risk of errors. And what's been very interesting recently is HMRC have been very focused on this, and they've issued some guidance which suggests a very high disclosure level for private equity executives when they submit their personal tax returns. What that guidance essentially says is that those individuals should be filing the information that the fund has provided them. So HMRC expects the individuals to be given a tax pack that shows their allocations from the various structures in the fund, things like their carried interest, their co-investment, and any other returns that they've received. But the new step is that is going to be expected to be put in front of HMRC. So the fund needs to think about what it's happy to put on those reports with that in mind. There's also a very interesting comment in the guidance that relying on US K1 information, which has been very common practice across parts of the market, HMRC do not believe that that is a good reflection of UK tax figures. They've been increasingly clear on that for some time. What the guidance goes is a step further and says, actually, if you rely on K1 data without making a further inquiry, you will not be deemed to have taken reasonable care in preparing your personal tax return. So if the fund gives you a K1, you don't challenge it, you don't ask any more questions, and you go away and use that to file your returns. If that gets inquired into and there's an adjustment to tax, then there will be penalty implications of that. So I think when we look at commitment to compliance in this context, it's really a great moment to be looking at those tax reporting processes, the information that is used in that process, and considering really whether how funds and managers are helping their executives manage their risks and putting them in the best possible position to file correct and complete information with HMRC. And this is not purely an individual risk. I think we very quickly see that inquiries into personal tax returns, they can flow into the fund structures. The first questions are, what does the fund look like? What documents have you been given? And it can also possibly taint other executives. So there's a huge house interest in managing that consistency. But it also comes down to culture, to being helpful, to having a good relationship with HMRC and be able to answer their questions effectively. So I think there's a really interesting wider conversation around commitment to compliance that goes beyond kind of straightforward entity level processes. It's really thinking, who are your other stakeholders? How are you managing these reporting processes that impact not only your executives, but potentially your investors and very much the relationship of the House and HMRC. The second theme that Martin has already floated is this idea of responsible tax planning. And to me, this will really depend on any PE firm's culture and risk appetite. And it's important to consider your own principles, right? Your integrity, the confidence that you build with your stakeholders. And again, applying this to a live example, which is particularly interesting at the moment, there's been a huge amount of conversation around the upcoming changes to the carried interest regime. And, this isn't a technical seminar, so I'll keep this very much in a nutshell, but essentially from the 6th of April, so in a few days' time, carried interest tax rates are going up to 32%. But the really interesting change happens in April 2026, when we're going to have a move of the carried interest regime from being a capital gains regime to an income regime. That introduces a potential top rate tax of 47% and a good rate of qualifying carried interest of 34.1%. But there are going to be conditions to meet. And the shift from capital gains in order to move it to an income tax regime is also something that can have lots of implications for international executives. So there's lots to think about there. And I think while we're still waiting for detailed information and detailed rules, the changes do actually give us a bit of an opportunity. Because we live in a world where, people move around firms a lot more than they used to. Carry can actually be quite flexible as a means of remuneration. I think there's a chance, if you have a good, strong understanding of your risk appetite and your frameworks, to think, hang on a second, where are we drawing the balance between carried interest and other forms of remuneration? What behaviours are we actually trying to encourage? And when you take a more holistic look at your incentivization, how you're dealing with your teams, and how actually that balance of carry and other reward is working, and if it's really fit for purpose. But I think that conversation is much easier to have where you have the kind of tax policy that Martin's been discussing, you really understand what those parameters are and how you approach tax, how you approach risk, and how you balance the kind of institutional versus the personal concerns. And then the third theme that I was thinking about when preparing for this is this idea of substance over artificiality. And as I mentioned up front, this has been a developing theme for the last 10 years. Everyone's been talking about it for a long time now. And it comes together in all kinds of ways with all kinds of recent law changes. To me, the direction of travel is very much in ensuring that structures are commercially led and we avoid things that could lead to scrutiny that don't stand up with commercial weight. So it's obviously extremely important at the deal level, but also at the house level, we've seen this theme starting to emerge. Now, the example that really sprung to mind for me is this idea of the salaried members rules. Now, those of you who are set up as LLPs in your PE firm will probably be pretty familiar with these rules, but essentially what they do is they limit who can be treated as a self-employed member of an LLP versus an employee within quite narrow parameters. So you essentially have to show that you are genuinely in business, you're genuinely in partnership, and that's tested in one of three ways. So either you have a truly variable share of the profits, and the profits themselves do vary, you have significant influence over the business of the LLP, or you've made sufficient capital contribution and have serious capital at risk in the business. So that was HMRC trying to introduce some objectivity. But in the background, there's always got to be that policy knowledge that the purpose of those tests is to limit the application of self-employed treatment. And in a world where national insurance for employers is now 15%, that is even more important and more costly than it ever has been to get that determination right. What's happened recently is the Court of Appeal have essentially really narrowed the definition of significant influence. So there's been a few rounds and it's been a little back and forth, but where it's landed now is that significant influence only counts, it only protects you as being a self-employed member if it really is enshrined in the partnership deed itself. So it's written, it's a legal right for you to influence that business. And the degree of the influence is then significant. So you really are in the meetings, you really are contributing. It sets a really, really quite high bar and really focuses on those legally enforceable rights. And I think for me, what that was a really healthy reminder of is that actually the importance of substance in your governance structures is so key. And in order to really understand the risk profile of any filing positions that are being taken where there is a degree of interpretation required, to really understand the policy of any set of rules, but also, again, your own approach to risk, your own culture in terms of how you deal with these kinds of issues, and having that clearly documented and consistent is really important and really helpful. Because otherwise, I think you can end up individually taking risks that leave you with a profile that actually, if you were to sit back, you might not be necessarily comfortable with. But you won't know that unless you've clarified that thinking already. And so these technical areas, they're not really isolated considerations. They're interconnected elements that can all link in with a framework of responsible tax. And by having that framework at house level, that helps you make informed decisions about the level of risks that you're willing to take and to be really comfortable with what good looks like and manage your stakeholders effectively. It helps you really reinforce those pillars of governance and risk management that are going to run through this whole conversation today and is very much the way of the world and the way the world is moving in the future. So if you have any questions, please do stick them in the Q&A and we'll deal with them if we can, or happy to speak separately if any of these themes are of current interest. But in the meantime, I'll hand back to Martin to take us through the rest of the presentation.
That was fantastic. Thank you very much, Jenny. I mean, some really important messages there about, I guess, the complexities and the process, but also, I guess, some of the themes coming out from there. Also, the ideas of transparency and reputation, and relationship with HMRC and other stakeholders. That was great. Thank you. And now, if we move on to the next slide, and we're going to talk about tax governance and its relevance to a PE portfolio company. Now, the section of this webinar was titled Enabling a Focus on Transformational Growth. So what do I mean by that? Well, with an investment horizon of typically 3 to 5 years, possibly getting longer at the moment, but within that investment horizon, there's a need to drive transformational growth in a relatively short period of time, which means that portfolio company management and the house need to focus from day one on operational effectiveness and developing and growing the business, because in reality, in the context of that investment horizon, exit readiness almost starts on day one. So this means not spending time on matters which may distract from that focus. Inefficient processes, missed compliance deadlines, tax authority inquiry, or any adverse surprises on exit, which may lead to a chip of the price on exit. And let's face it, the tax code is complicated. I think Jenny's already demonstrated there are these areas of complexity, but tax code is complicated. The UK tax code is 20,000 pages long, and there are approximately 40 different taxes a business can pay, with compliance checks and penalties across each of them. But compliance with that tax code is a very clear, measurable, and tangible indicator of the overall governance of the business. So with all of that in mind, let's drill down. And if we move on to the next slide. Now, I'm metaphorically sitting at the desk of a CFO or FD at a business which has recently been involved in a private equity transaction. So what's on my mind? Well, it's an exciting time. The business has been successful to date, and the investment should be a turning point in the growth of the business. Now, bearing in mind the growth goal for the business in a relatively short period of time, I want a clear understanding of what I'm responsible for, what could I be held accountable for, and also with an eye on future warranties and indemnities, which I may have to sign off on. So within that, I need to identify the material risks that will prevent us from meeting our strategic goal and understand how I manage those risks. And if we focus on tax, well, actually, we've just been through a due diligence process, and I should be thinking about the tax issues that came out of that recent due diligence. How do we prioritize and remediate those issues? Were those issues one-off matters? Why did they happen? What was the root cause? Was it resourcing, lack of understanding, miscommunication? If I don't know, then how do I ensure that this doesn't happen again? And so with all of that in mind, I want to know what my immediate key actions are and have a clear action plan. And this will be driven by the due diligence report and 100-day plan. And I also need a framework to ensure to help me to meet the growth goal for the business. And this can't be hampered by risk and errors in compliance or adverse surprises on exit. So I need to make sure that tax is on the board agenda. I need to ensure that we take a consistent approach to compliance. I need to manage resource, key person risk. I need to ensure that the tax implications of our growth plans are understood across the business. So how do I achieve this? And if we move on to the next slide. Well, as a business grows, it's important that the tax framework grows with it. And this is inevitably going to lead to greater formalization and documentation. And as we said earlier, PE-backed businesses are fast growth with a very clear strategic goal within a defined timescale. So they must have an eye to the future and ensure their controls are scalable. And so the important point is to ensure that there's an appropriate and robust foundation in place. And what does that foundation look like? On to the next slide, please. Well, I see part of my role in trying to make tax governance clear and straightforward and to demystify what we actually mean by tax governance. And now, while it may involve many moving parts, it's not overly complicated. And there are plenty of easy wins that can significantly enhance your tax governance framework. And the core principles remain consistent as the business grows, even if the details and scale vary. And here's a three-layered approach. At the top, we have a tax policy. So if we think about this as the business's tax operating manual, it outlines strategies and practices for managing tax obligations effectively, including understanding and complying with tax laws, ensuring accurate reporting, paying taxes on time. The policy sets out clear roles and responsibilities, the approach to compliance and planning, risk appetite, risk thresholds, and it also includes guidance on claiming tax credits and deductions. For example, R&D tax credits. Is there the process in place to ensure that the credits of that sort are maximised? And with all of the complexities and potential inquiry in mind, the policy also needs to cover areas such as tax outsourcing, the use of third-party advisors, and interactions with tax authorities. And sitting beneath the policy are documented tax processes. So while the tax policy sets the strategy, documented processes ensure a consistent and comprehensive approach to compliance. And this helps to manage tax compliance risk and mitigates risks if a key tax or finance person were to leave the business. And this layer includes appropriate training, for example, ensuring everyone within the business is well trained in order to maintain effective tax governance and compliance. And supporting all of this are a series of tax risk management tools. It's the utilization of tax calendars, review checklists, risk and control matrices to ensure we keep everything on track. And the purpose of this is to ensure timely risk identification, escalation, and remediation. And then if we link all of this back to the questions our CFO was asking earlier, next slide, please. Well, actually, each of the questions the CFO was pondering can be answered by an element of the tax control framework. And what this really means is that the business can take a proactive approach to managing risk so that issues are identified at an early stage and can either be rectified or, at the least, that robust rebuttals are prepared in light of any future concerns that may arise on exit. And what's really vital in this fast-growing business is that the policy is shared with other relevant internal stakeholders so that they have an awareness of when tax needs to be considered. For example, if there's going to be overseas expansion, what are the tax implications of people traveling cross-border and setting up overseas? If there are going to be bolt-on acquisitions, we need to know the impact of this, as well as incorporate an entirely new set of processes and people into the business. So having said all of that, and having said about some of the issues that come out of tax due diligence, I'll now pass over to the experts, Nuala and Will, who are going to talk about some of those common DD areas that arise and also how they could potentially affect deal price on exit.
Great, thanks, Martin. So now that we've taken a look at those key issues for the house level and also the key priority items for CFOs, Will and I are going to talk through some of the key tax issues commonly identified in due diligence on an exit event and how an effective tax governance framework can mitigate and protect against such risks. By way of introduction, for those of you who don't know me, I'm Nuala McLaughlin, a partner in our transaction tax team, and I focus on private equity and mid-market transactions, assisting throughout the transaction process, right through from exit readiness to post-completion integration and subsequent bolt-ons. And I'm joined by my colleague, Will.
Thanks, Nuala. Just to introduce myself, I'm Will Searle. I'm a transaction tax director focusing on private equity transactions, both from a due diligence and a structuring perspective, but mostly focusing on exit readiness and pricing tax into the completion mechanics, and also looking at tax from an SBA perspective. Now, in order to make this session a bit more interactive, we wanted to understand from the audience what potential risks they've seen on a due diligence, so to understand what we would like to talk about. So if we go to the next slide, hopefully there should be a poll. So if people could answer that poll. And in the meantime, while people are answering that, Nuala, can you just explain how you think a good tax governance framework can help on transactions?
Yes, of course, Will. So putting in place an effective governance policy provides the opportunity to mitigate tax risk from the outset of the investment lifecycle and then protect and enhance value in the investment portfolio right through to exit. So where risks are identified in an exit diligence process, the outcome can quite often be protracted negotiations, which can be both time intensive and costly from an advisor perspective and also a management perspective. Most significantly, there are pricing implications, and we typically see price chips or escrows as an outcome. The common risk areas we're going to discuss in a bit more detail are often material and quantum by their nature, and they may span over a number of years. This can lead to tax, interest, penalty, and advisor fee costs. There are also reputational considerations to take into account. Ultimately, tax risk can erode value for private equity and management teams on an exit event. An effective tax governance framework should give assurance over the tax compliance profile during the life cycle. Together with robust tax controls and taking appropriate advice, the likelihood of surprises on the tax side at a transaction point should be mitigated. The documentation and policies and procedures should also help assist in a smoother diligence process. Going back to those key CFO questions from a transaction perspective, the first port of call is reviewing the tax structuring and diligence work undertaken on the investment and ensuring that all those required actions and recommendations are completed in a timely fashion. And as Martin mentioned, that they're built into the 100-day plan as required. Looking forward to an exit event, the aim is to have in place comfort and support in respect of the tax profile on the portfolio as they enter into the diligence process. So now if we take a look at our poll results and have a look at some of the common pitfalls we see in diligence in a bit more depth. Great.
That's interesting. So it seems to be a sort of an even split with transfer pricing sort of coming at the fore. But if we take one of the sort of examples, which is management equity, as most of you know, management equity, a key component of which is sweet equity, is often a key risk area that we have identified on due diligence. And this is often seen where, for example, a new CFO is recruited midway through the life cycle in order to prepare for exit, or there was a management equity reset. Commercial drivers are often the key focus, and tax is often neglected. Now that's until an exit, when buy-side teams see that equity is issued, and if there's no 431 elections, there's no tax valuation. This often is a key risk area that they try to price into the deals. Now, management equity type issues aren't covered by W&I insurance because of the subjective nature of the valuations. However, because buy-side teams will utilize the valuation that they have, which is the exit valuation, this often becomes a big issue. And especially when buy-side teams might, for example, price in a 222 gross up risk, which could potentially double the risk. And so therefore, how does a tax governance framework ensure that this risk is mitigated? Having a tax policy which ensures that valuations are always undertaken whenever there was an equity change to the equity or 431s are entered into will be a key driver to ensuring that this risk does not become a price chip issue on a transaction. Now, Nuala, you've often seen businesses expanding overseas. Can you just talk us through some of the sort of risk issues that you've identified on those items?
Yeah, so in a nutshell, there are limited overseas activities which can be undertaken without a need to take some advice and to undertake overseas tax registrations. So whether there's simply a hire of a remote worker in a foreign jurisdiction or setting up an overseas office or even selling goods or services to an overseas customer, these types of scenarios can create tax implications which range from registering for local payroll, triggering an overseas permanent establishment, or registering for local corporation tax and sales taxes. There can also be withholding tax implications on repatriating funds back to the UK. So quite a lot to think about if there are any type of activities taken outside of the UK. And it's important to ensure that all of the local tax implications are considered on entering into any new territory, and advice is taken on application of double tax treaties, which can give a prospective buyer some comfort on non-UK tax matters. A key risk that we see crop up time and time again on diligence is US sales taxes. So where there's an operation or selling goods or services into the US, where there's US customers, even if there isn't a US footprint, so an office, for example, a nexus can be created, and as such, a reporting and filing obligation. The thresholds vary state by state, making application of these rules pretty complex. There are certain exemptions, it's worth noting, but these can only be available in very specific circumstances and quite often rely on quite stringent documentation being in place. We see this come up as a risk for a number of reasons, either through a lack of awareness of the rules, breaching the threshold inadvertently, or a lack of support for an exemption. So as I mentioned, having that documentation on file to support the position. Failure to collect and remit US sales taxes can quite often result in significant tax liabilities as well as penalties and interest. A significant amount of work is usually required to assess and correct the position, and we typically see price chips and escrows to protect in this respect. Another common pitfall that we see is due to the increase in remote and overseas working, there's been an increase in the number of UK companies where there are non-UK resident directors. And these directors might travel to the UK for board meetings, and they may spend time working in the UK. A tax risk arises where UK PAYE or national insurance hasn't been considered with respect to those UK work days of the individuals. Quite often these arrangements can span a number of years, and they're quite often in relation to highly remunerated individuals. And where identified in a diligence process, they can result in a price adjustment. Keeping on the theme then of payroll-related risks, well, tell us a bit more about IR35 compliance and why that's such a common risk area in diligence.
Thanks, Nuala. Yeah, so off-payroll labour and the sort of complexities of IR35 has become one of the sort of top areas that we've identified across all sectors. And this is particularly accentuated through private equity's adoption of a buy and build strategy. So when you're sort of doing a bolt-on acquisition, the business, which is fast growing, might not have considered IR35 because it might be considered to be small for IR35 purposes. However, then when you're trying to sort of harmonize the business structure and the processes, you soon become part of a larger group and therefore need to consider IR35 from a diligence perspective. And so ensuring that this isn't a risk on exit. Now, we've often seen that having a good governance framework around ensuring that an employment status review is carried out on a periodic basis, reviewing the contract to ensure that these are considered to be self-employed individuals rather than employees, undertaking CEST analysis, and also understanding how the contractor engages with other businesses is key to understanding whether these IR35 risks will become a risk for the business, because this could be a common risk that the target applies will have a risk issue on diligence. Now, we also see off-payroll labour in the form of where businesses have split roles. So an individual might be a chairman, but also provide consultancy services. Without a clear segregation of the duties between the consultancy provided and the NED role, there is often a risk that all payments made to that person is subject to PAYE and NIC. This is a key area, particularly because national insurance contributions have a statute of limitations under normal circumstances of 6 years, and PAYE has 4 years. And so therefore extrapolating a risk on these payments over the course of these statute of limitations often has a significant bearing. And so therefore, in order to protect this, we often recommend that there is a clear segregation of duties through a contract and through separation of payments to ensure that this risk isn't identified on a buy-side due diligence. Now, Nuala, I think you were going to mention about financing, which is obviously quite a common theme on private equity structures. What sort of risks does financing present from a tax perspective?
Thanks, Will. So as you've mentioned, and as Martin noted earlier as well, the structuring and financing considerations can be pretty complex post-private equity investment. The debt profile of the portfolio investments will typically take the form of private equity and management loan notes, and third-party debt. This can lead to complex withholding tax and interest deductibility provisions and considerations. The starting point, like we've talked about before, and one of the key things should be on the CFO's agenda, is to ensure that the tax structuring advice taken in respect of the investment has been implemented and the recommended actions are completed within the necessary time frame. And again, these should be built into the 100-day plan and the documentation maintained and readily available on file. On exit, the risks we typically identify in this respect or where there's been a failure to correctly implement tax structuring advice, or where there's been a refinancing or change to the debt profile in the holding period. Two of the key risk areas are withholding taxes on interest and interest deductibility. So taking those in a bit more detail. With respect to withholding tax on interest payments, as noted, the key here is to ensure that the recommended actions from the tax structuring are taken in advance of payment of interest. Notably, where there's a recommendation to list loan notes, where there's an application to apply a reduced double tax treaty, or where the double tax treaty passport scheme is being applied. A topical point on double tax treaty passport application currently is the requirement for borrowers to inform HMRC of any passported loan as soon as reasonably possible. Previous guidance had been at least 30 working days before the interest payment. We've also seen instances on diligence where the loan notes have not been listed in advance of the first payment of interest, and that's resulted in a withholding tax obligation. Lack of compliance in this respect will result in potential withholding tax payment and reporting failures, and this can lead to price adjustments on an exit. With respect to interest deductibility, tax advice should be obtained to support the filing position, and the tax return filings should reflect this advice. Quite often, where business hasn't taken advice, this is where we see errors and mistakes made. There are several restrictions which can deny or defer deductibility of interest, and typically this will affect the payment profile. The restrictions being late payment interest rules, which are a deferral, transfer pricing, which may cause a denial in part, the hybrid rules, which may also cause a denial in part, or the corporate interest restriction rules, which are a deferral. And again, this is a complex area, so tax advice should be taken in this respect, which feeds into the tax governance framework and making sure that you're appropriately advised where there's a debt profile in the business. That moves us on to transfer pricing. So again, coming back to where business experiences rapid growth, and that results in international expansion, transfer pricing policies and procedures can often lag behind as they focus on your commercial priorities as you grow. The UK does have a small medium enterprise exemption, but it's worth noting that other territories do not, such as the US. And as such, it's increasingly important to consider and monitor your transfer pricing obligations when entering new territories. As I mentioned, the US requires transfer pricing documentation to support related party transactions, and there's significant non-compliance penalties where there's an understatement of tax. Therefore, it's good practice and where applicable to ensure that related party transactions are conducted on an arm's length terms and appropriate documentation is maintained. A review of related party transactions, particularly cross-border ones, can help in addressing any potential compliance failings and see the implementation of a suitable transfer pricing policy prior to a due diligence exercise. So Will, now that we've gone through the key tax risks that have come up, what's next?
So these are clearly some of the 5 top risks that we've identified, but let's hand over to Martin, who will sort of explain how he sees private equity houses manage these risks.
That is great. Thank you very much, both. I think there's just so much to take from that talk, including all the areas of complexity that are going to be relevant to a lot of businesses. Because I think one of the key points from your talk was the fact that these are common tax risk areas, and I think that was borne out by the results of the poll. These are common areas that come out of due diligence. The risk profile may change as the business grows and there's additional regulation that's required. But the important thing is, do the people within the business, do they have an awareness of these risk areas? And how do we make sure that those risk areas are addressed? And actually, many of the points that you raise in there are points that could be included within a tax policy to ensure that there is an appropriate trigger for consideration of these points as the business grows. And then we move on to the next slide, please. Let's think about the priority for the house during the holding period, from initial investment, action plan, ongoing assurance, and then exit readiness and preparing for exit. Well, ultimately, the house wants to ensure the business has met its potential and that the business has developed and grown in accordance with the growth plans, and that the portfolio company maintains that focus on growth. So interests are all aligned here. We want to see the growth, and we want to avoid any adverse surprises at exit. So there needs to be a clear action plan. Well, that clear action plan, to a degree, is prepared, isn't it, in the form of the due diligence, and also in the 100-day plans. And we want to make sure that the points within those plans, within the DD, within the 100-day plan, are addressed so they don't persist at exit. We want to manage those risks. And from a governance perspective, this has a couple of elements, really, from looking at it from the house. Well, we want to make sure that the actions, going back to what Nuala and Will said, we want to make sure that the actions identified and the structuring is actioned and implemented appropriately. There has to be a focus on making sure the implementation takes place. But also, we want to be comfortable that the root cause of any issues identified at due diligence have been identified. As I said before, if the root cause hasn't been addressed, then it could well happen again. So we have a focus on this, and we have a focus on providing ongoing assurance to the house from the portfolio company that compliance continues and that risk management continues, because we don't want issues being addressed at the 11th hour. So if we have that ongoing assurance, ongoing focus on governance, no adverse surprises at exit. And the approach that houses take in this regard can vary, moving from a passive to a more active to a proactive approach, ranging from effectively leaving management to handle operations to actual greater involvement in operational issues. Well, I'm not saying that one size doesn't fit all, but the direction of travel is certainly for a more active approach. And regardless of the approach, actually meeting those goals should be relatively straightforward as long as there's a focus on it. And again, I see this as a layered approach. So we need to make sure that there's board awareness of key tax risk issues, and we want to make sure that any portfolio company board representatives from the fund or the manager understand the key tax considerations and their impact on the business. So they should be able to identify potential risk and ensure actions are taken to address them. So this isn't about them becoming tax experts, but it's ensuring that there's an appropriate framework in place to identify risk and the triggers for additional action. So we have that board awareness. We're also seeing a move towards set tax principles. So the manager can establish clear tax principles as part of the investment, outlining expected behaviours for the portfolio company. And these should cover things from compliance requirements, use of third-party advisors, interaction with HMRC, but also important other matters such as compliance with the corporate criminal offences legislation, for example, or keeping an eye on the upcoming failure to prevent fraud legislation that takes effect from 1st of September this year. So we've got board awareness, we've got the tax principles. How do we go about obtaining periodic assurance? And best practice to implement regular checks to ensure principles are met. It doesn't mean getting involved in the weeds, in the granular detail, but it's just ensuring the principles met and that risks are being managed effectively. And I'll hand over now to Emma Bailey just to discuss some of the tools that we use with our clients in meeting those objectives.
Perfect. Thanks, Martin. Hopefully everyone can hear me. And by way of introduction, I'm a senior tax manager in the tax assurance and risk management team with a particular focus on private equity. And I'm now going to explore some of our digital products, which Martin alluded to, that can help portfolio companies strengthen their tax control framework. So firstly, as we've got on screen here, we've got the Tax Operations Maturity Model, or TOM tool for short. And this tool provides a clear assessment of the maturity of your tax operations, governance, and control framework. It's a very simple to use questionnaire and consists of you answering a series of questions about your business, covering tax governance matters and specific tax questions such as on corporation tax, indirect taxes, and employment taxes. The result is a heat map for your business, which you can see an example of on screen, which shows areas of strength and areas which require some improvement. For portfolio companies, the tool can help you focus on key operational aspects by pinpointing areas that need attention, and it also supports the execution of the 100-day plan, allowing you to prioritise actions effectively. By completing the questionnaire annually as well, you can track progress and observe the direction of travel of your tax governance year on year. For private equity houses, the TOM tool offers transparency over the tax operations of your portfolio companies, keeping you informed of areas that still need some attention. The questionnaire also includes some free text space, which allows portfolio companies to document where their concerns are in relation to tax, adding another layer of transparency for the PE house. Additionally, the TOM allows you to compare multiple companies within a portfolio, which can allow you to focus stakeholders' efforts effectively. And the TOM tool is also global, so that the TOM questionnaire can be used for various jurisdictions, as we recognise that tax regulations vary depending on where your portfolio is based. Next slide, please. Next up, we have our Tax Control Framework, or TCF toolkit. With tax authorities increasingly focusing on transparency and behaviours alongside the growing complexity of UK and international tax regulations, tax governance and managing tax risks have become a top priority for many organisations. And to tackle these challenges, we have developed our own Tax Control Framework toolkit. The toolkit aligns to Martin's slide earlier, which referenced the three-tier approach from having a tax policy down to having process documentation for each of the operational taxes. It's been designed to help portfolio companies confidently navigate compliance challenges, ensuring they are well equipped to manage risks and demonstrate robust governance. So portfolio companies can benefit from best practices for developing a strong tax control framework. And this toolkit offers a cost-effective access to our own expertise, which enables portfolio companies to take ownership of their own tax governance and risk management. It helps to ensure that you can demonstrate strong governance to your stakeholders, so for example, the private equity house where relevant, and tax authorities, which is crucial for maintaining trust and also preparing for successful exits. Examples of what is included in the TCF toolkit can be shown on screen. So, for example, tax principles, tax policy templates, and also tax process documentation templates are included as well. Next slide, please. Next, we have our e-learning modules, which we have developed here at BDO. As agile working has evolved, so have our learning tools, and we have developed e-learning training that offers significant benefits to portfolio companies and also PE houses themselves. Communication training are among the 6 principles of the CCO defence and Bribery Act defence, and they are key elements of compliance with the legislation. It's important to raise awareness of these laws within your business and make sure your employees are aware of what red flags to be looking out for and also what your whistleblowing processes are to escalate any issues identified. And it is also important that the business should be able to demonstrate top-level commitment for these legislations. Our e-learning modules cover CCO, anti-bribery and corruption, as well as other compliance topics such as anti-money laundering and data protection, as well as the new offence which is coming in on the failure to prevent fraud. These help portfolio companies to stay informed and compliant. And we also offer tax technical training, such as on the subjects of VAT, to make sure your finance teams are keeping up to date with tax regulations. The e-learning modules can be purchased off the shelf or customized so that we can add specific tailored case studies to your business and details of your own whistleblowing processes to really make sure that the e-learning journey is a personalized experience for your employees. We also offer a hosted learning management system too, as we recognise that smaller businesses might not have this in place. And for PE portfolios with multiple companies on multiple systems, it helps to align compliance efforts within a portfolio. Next slide, please. Now, finally, we have our corporate criminal offences or CCO toolkit. The toolkit helps to ensure that companies, such as portfolio companies, have the necessary resources to construct their defence effectively. It includes template wording again for a CCO risk register, internal and external communication, and external contract wording. Portfolio companies can benefit from clear guidance and practical tools to simplify the process of building their CCO defence. And by using this toolkit, again, we can effectively address those compliance requirements and assure stakeholders, such as the PE house, that you are taking proactive measures to mitigate the risk using quick and easy wins. The toolkit also helps to build a reasonable and proportionate response to the legislation, which again is proportionate to your business. Finally, for private equity houses, this can be used across the PE house and portfolios to make you are aligned in your efforts to comply with the CCO legislation. It helps you to maintain consistency across your investments, reducing the risk of non-compliance and also enhancing your reputation for robust governance. I'll now pass back to Martin for concluding comments.
That's great. Thank you. Thank you very much, Emma. Thank you for the other presenters and everyone who's dialed in today. We're right up against the hour, so just very short couple of words. So many thanks for your time this morning. Hope you found the webinar both interesting and useful. I think the main takeaway, I hope, is that having a robust tax governance framework enables a business to focus on growing the business, protects and enhances value, and ensures that on exit there should be no adverse surprises, and perhaps most importantly, that the foundations of doing this are actually relatively simple to build. I said we're right up against the time, but any of us on this webinar would be delighted to have a further conversation. So there will be a follow-up email following this presentation, and we look forward to speaking to some of you again in the future. Thanks very much.